I'm here with Steve Kempler, and we're here to talk about his new research paper. There are a number of reasons why investors want infrastructure exposure in their portfolios. Can you summarise the key benefits?
Sure, Simon. We find there are a number of reasons why investors look to allocate to infrastructure as part of a broader balanced portfolio. And some of the key reasons from our discussion are investors seeking long-term income-oriented returns that often have an element of inflation linkage within them, as well as the prospect for longer-term capital appreciation. We also find some of the key benefits of infrastructure have return profiles that are de-linked from economic cycles, as well as having risk profiles that sit somewhere comfortably between ordinary equities and fixed income.
Investors often debate the merits of listed versus unlisted. However, in your research paper, you argue that they are the same. Why is that?
Yes, Simon. In the paper, we looked at a lot of infrastructure subsectors, and we found that inherently the underlying assets themselves are similar or the same. We certainly found that the regulators across all the assets are the same, and we also found that, contrary to popular belief, management expertise and alignment and governance isn't any better in the unlisted space. And our conclusion really was that infrastructure is a single asset class, not differentiated by the means of ownership or the capital structure around those assets.
How do the returns achieved compare between listed versus unlisted?
Yes, Simon. Well, over the longer term, we find that returns are generally similar regardless of the means of ownership, but over shorter multi-year periods, we do find that there can be material divergences between returns, partly because of the valuation methodologies used. In the unlisted space, you're marking to model; in the listed space, you're marking to market. So there will be divergences, of course. We actually find that a better way of comparing returns over shorter term periods between listed and unlisted ownership is by looking at the underlying assets that they're invested in. Within the global listed infrastructure opportunity set, the largest geographic concentration of privately owned infrastructure tends to be in North America. And so within the research paper, we've done a comparison looking at the returns achieved of regulated electric companies in the US. We've taken the 5 largest by population of each listed and unlisted ownership and found that there really is little in the way of difference between both the allowed ROEs from regulators, but also, more importantly, the actual returns achieved from those businesses. And similarly, the level of gearing in both of these buckets is similar, if not almost the same. So here we find a good example of a very large and deep investable subsector where we really think it is a single asset class regardless of the means of ownership. If we jump across the Atlantic to the UK, here we find a large subsector of regulated assets that have been privatised now since the 80s, a very long and deep history of unlisted ownership, and we've compared one subsector, the UK regulated water companies, between listed and unlisted ownership, and over the last 5-year regulatory period that ended in March 2020, we actually found that the 3 listed UK water companies outperformed the unlisted water companies by about 3% per annum compounded over 5 years in terms of premium on the regulated return on equities achieved there. So a good example where listed companies have outperformed across the board, and they have actually done so at materially lower levels of risk, or gearing about 10% below where the average of the unlisted companies has been.
Are there any assets that investors can only access in the listed infrastructure space?
Generally speaking, the types of infrastructure that's available to listed and unlisted investor varies across subsectors, but generally speaking, listed infrastructure tends to be more readily available in a diversified way. There are certain subsectors that it is very difficult to own infrastructure in an unlisted manner, particularly regulated utilities in North America, whether it's electric, water or gas. The regulatory hurdles make it difficult to take private. And similarly, large pipeline networks we also find very under-owned or not owned at all by unlisted investors.
COVID has had a significant impact on our daily lives and the markets. What is the outlook for infrastructure in a world of COVID?
Yeah, as you say, COVID-19 certainly has had a material impact on infrastructure, not just as an asset class owned by investors, but from a needs perspective in terms of our basic access to electricity, water, gas, and increasingly the more important usage of communication services wirelessly. We see that through investments in mobile phone towers. Certainly at the most acute end, we see an impact on transportation assets, namely airports and toll roads, who are really reliant on one thing: their users. And clearly in these unprecedented times of lockdowns, the use of transportation infrastructure assets has been much more limited, and that has certainly had shorter term ramifications for these businesses. Longer term though, and the longer term outlook, we think infrastructure is really a sound place to invest today. There is an increasing need for investment in the space. We certainly see governments supporting infrastructure spend as a way to grow economies out of the deep recessions that we find ourselves in today as a result of COVID-19. People will certainly drive again, they'll certainly fly again. Most of the assets that we invest in the transportation space are very long dated in nature, 30, 40, 50 years or more concessions, and the short-term impact of COVID, whilst comes with some behavioural changes, certainly doesn't change the long-term value of these businesses. And then finally, over the longer term, as the growth spend does come into these networks, particularly the regulated assets, where we are seeing increasing spend on decarbonisation, build out of electric networks to support more green energy. We see increasing growth and returns available to investors in the infrastructure space in a way that certainly remains decoupled from the broader economy.